I've laid out kind of three scenarios for the markets, and this is what we're working through right now. Is kind of these three scenarios. How long does this actually take, and what's the impact to markets, GDP, et cetera?
Oh, this is awesome. This is what everybody wants to see. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the epically furious portfolio manager, Lance Roberts. Lance, how you doing?
Why am I epically furious?
Well, because we're going to talk a little bit about the impact of the war, and it is Operation Epic Fury.
Got you. Okay.
Yeah. Real quick before we
I thought
get
you meant I was over here furiously working. So
yeah, well, you work furiously. You're kind of epic. Sometimes
there,
you make me furious. Sometimes you make me epically furious.
there you go.
Oh,
There you go.
applies in all sorts of ways. And real quick before we jump into the details here, just a reminder for folks, if you're watching this video the day it launches, which is Saturday, you have like less than 48 hours to purchase your ticket for the Thoughtful Money Spring Online Conference. If you haven't already, I'll remind everybody about all the details about it at the end of this discussion. But it is our best faculty yet. Could not be more timely, especially with everything that's going on in the Middle East. So if you haven't bought your ticket yet, sorry, it's your last chance to buy your ticket at the last chance to save price. So the conference itself isn't until a week away from now. Yeah, exactly a week away from now. But the price goes up to the full price at midnight on Sunday. So you can still get it at the last chance to save discount by going to thoughtfulmoney.com/conference. And that link also has all the details, everybody in the faculty, the whole agenda for the day. It's going to be wonderful. All right, Lance. So uh, we've talked a little bit about the impact of the war on the markets. You've said in general, these tend to not drive market actions that much unless it impacts the market's earnings expectations. And what we have seen in this war is that the price of oil has become much more volatile. It's raised materially. It got up as high as about $120 a barrel briefly. It's now down more like around $100 a barrel, though I haven't looked at it yet this morning. But obviously, if that is something that the markets think could sustain, then that does start to roll into corporate profit margins. Obviously, we've seen the markets be a bit more weak and some additional volatility entered into the markets here. Right now, what type of discount do you think, war discount, the markets are applying? And do you expect that, all things being equal, to get worse from here?
So a couple of things. So, where, and this is so in general, your statement is absolutely correct, right? But you also have to drill down into the areas of the market that are going to be impacted the most. So, for instance, at the beginning of this year, you and I were talking about this kind of this reflation narrative, and I wrote a couple articles about this reflation idea that this economic growth resurgent this year was going to occur, and that was benefiting areas like staples, energy, materials, industrials, utilities. They were trading exceptionally well. Emerging markets and international markets were trading exceptionally well. And ever since this started, those have been the areas that have been hit the hardest. And the companies like NVIDIA and the Mag 7 actually have been holding up much better. And we've seen this rotation back to growth a bit because the impact of the war, or it's not a war, right? We haven't declared war. The outcome of this military conflict and what's going on oil prices isn't going to impact the earnings of Google as much as it's going to impact the earnings of, say, a Walmart or Target, where higher gasoline prices are going to impair the consumer. So if you think about where an oil spike is, and some of the estimates are, if this is sustained for 90 days or 180 days at these price levels, that's $600 to $800 in additional energy costs that a consumer will pay. Well, that they don't have an extra $600 to $800. It has to come from somewhere else in their budget, right? And that will obviously cut back on them, shopping as much at Target or shopping as much at, a Walmart or a Costco or whatever it is. So that's why we're seeing this bit of risk off rotation in the areas that were the most beloved areas. And we had a lot of that momentum chase in those areas, and that's been unwinding pretty sharply over the last couple of weeks. So again, this is why the headline index hasn't come down that much, because you take a look at the S&P 500, yes, it's come down, but those five, six sectors of the market, they make up less of the market cap than technology alone. So again, that's why the overall index hasn't come down as much as some of these other sectors.
Okay. Um, so, I mean, I think in reality, the answer depends on how long, this conflict
Mhm.
persists. Is if, the straits are really, this is largely around concerns around the Straits of Hormuz or the
Right.
Strait of Hormuz, and whether tanker traffic will resume going through there or not anytime soon. Obviously, the longer it takes for that to happen, the larger the oil price shock will be to the economy, correct?
Right. Correct. Yeah, yeah. And again, I think 2 weeks ago, when you and I were talking, because I was not here last Friday, it was Michael Leibowitz, but I said at some point, they're going to have to resolve that. Put a couple of destroyers in the middle of the Strait of Hormuz, protect it so ships can come through. And so again, they're going to have to do something to open that strait back up so that those ships can start to move crude oil again, because 20% of that supply is being disrupted. And that's a very big disruption on oil supply that is primarily going to impact Europe more than the US because we have a lot of supply here. But it's certainly going to impact global oil prices, which is what feeds through into everything else, right?
Yeah, and just to clarify, you said 20% was restricted. 20% of the world's oil supply
Yes.
goes through the Strait of
Yeah. Yeah.
Hormuz.
Yeah.
Um, Almost 100% of the Strait of Hormuz's traffic isn't moving through right now, although we've heard reports of Chinese ships making it through, and I think an Indian tanker is reported to have just made
Yeah.
it through. But most ships aren't. All right, so this all depends on how long this lasts, as we talked about. Um, Lance, I have been learning in real time the dangers about talking about reported intelligence on the war on a live pro or on a public program like this, because invariably there are lots of people out there who get their news from different sources who aren't going to believe, no matter what you say, there's going to be a cohort that doesn't like what you say or
Oh, yeah.
doesn't believe what you say. But basing it off of official reports, and I try to listen to the daily reports from the Department of War that are just, recapping what happened yesterday and lay out the plan for today. And I leave it up to everybody watching whether you want to believe that or not. They are saying that uh, obviously the war is going very well. We have full air superiority. We've diminished the missile and drone launches, I think, by like 90 to 95% since the start of the war. So, in terms of degrading Iran's capabilities just to strike at things, doesn't mean that Iran isn't still striking at things. They obviously are. We're reading about them every day. But basically, oh, and they've sunk basically Iran's navy, they're saying, is functionally inoperative right now. It sounds like there's still some ships out there, but they have gotten most of them. They're obviously uh, there's been sort of rumors about Iran mining the strait. Today, they said they don't think they've done that, and they certainly have means to remove the mines if they want to. Whole point being is I think right now, with the information we have, which may be quite imperfect, but with the information we have, it seems like the odds are that this will still be relatively short-lived. And by that, I mean probably weeks. And there's really two reasons it could be short-lived. One is we could do exactly what you said, Lance, which is we could degrade their capabilities enough that we feel comfortable putting our warships in the Gulf and we just escort everybody through there, right? The second is that the operation could be over. And the president has said many times, it's practically almost over. We don't want to leave too soon, but and whether you believe him or not, I'm gonna stick my neck out and share something, and love to get your reaction to it, Lance. Which is, I totally understand the concerns that this could turn into a forever war and boots on the ground, and it's another Iraq or it's another Afghanistan. The administration, at least at face value, seems to be saying, look, we're totally aware of that concern. This is not one of those wars. That's not our objective here. They've had their four objectives that they've been pretty consistent about. But just looking at Trump's history here, it seems that he's got a pretty consistent pattern of basically, it's certain, everything he does here is a gamble. It's a roll of the dice. It could certainly blow up in his face. But he basically says, look, I've got a problem. I'm going to go use some immediate acute force to try to make that problem better. Not necessarily saying I'm going to solve the problem forever, but like let's look at Venezuela with Maduro, right? I'm going to roll the dice. I'm going to go in there. We're going to try to take this guy out. Maybe it won't work. You know, worst case scenario, if it doesn't, I have the same issue I had yesterday. But if I replace him, I get him out of there. I put somebody else, you know, in charge of Venezuela, or let the next person go in. Well, hopefully they'll be better than Maduro, right? And then things are better for me. But if they aren't, I'm no worse off than I was before, right? So like I would encourage people not to dismiss the odds of just at some point Trump just saying, okay, we're done. You know, yeah, you know, we didn't have regime change. It's still the same Mueller regime that's running Iran. But hey, we've totally set them back many, many years. You know, hopefully we put the fear of God in them that if they displease us again, we'll just come right back in and do this. So maybe they'll be a little bit more compliant, or maybe they'll be at least a little less antagonistic. And we've certainly degraded a lot of what they can do. And it's going to take them many years to rebuild that if that's what they choose to do. So in his mind, that's a better, right? So anyways, curious to hear your thoughts on that.
No, no, I mean it's this is always the problem when we go into these type of conflicts is not having a clear cut end goal where it's like we're just going to go in and this is our goal and we accomplish this goal, we're done. And either they don't have that fully laid out, and this was kind of one of the problems we did shock and awe with under George W. Bush in Iraq, which is we went in to Iraq with this whole idea that they're weapons of mass destruction, etc. But there wasn't a real end game. And even some of the generals back then complained about the issue is like, there's not an end game to this. If we're here to conquer and do a regime change, that's fine, whatever it is, but lay out that goal, lay out that process so we can accomplish it. And so that seems to be the one kind of thing that's sitting up in the air is like, how do we get out? How do we back out of this, right? So is the end goal of this just to, resolve their ability to create nuclear weapons entirely? If that's the goal, that's great, that's fine. Or is it a regime change, or what is it? And so I think that at some point they're going to have to define what that end goal is and then go after that objective. And so, and maybe they have that.
Well, just to be clear,
I'm not in the halls of
yeah,
Washington.
I am lilistening to the daily reports, and
Right.
again, folks, I'm not swallowing everything whole cloth, but I do want to hear what they're saying. Hegseth has been really clear from like the first day. This is not a regime change war.
Right.
This is not, and he talks about serving in Afghanistan and getting to the point where he was like, "What are we doing here?" Like, I'm so unclear on the mission. So they, in their mind, they're very specific about what the objectives are and when they'll pull out. That might not be crystal clear to the public. So,
No,
make
no,
up
and
your own
that's
mind on that. But yeah.
right. No, and I think and again, I think that's what we need to know is exactly what is the goal. Where does this end so that we can resolve this issue and then pull back and then kind of set things back to normal. My point is this, is that it's all about time. And if the market, if this is a 30-day event beginning to end, 30, 60 days, the markets are going to be fine. We'll work through this. The markets may be off, 5, 10% in total, and the markets will work through this process, right? But if this starts to sustain out where it becomes 90 days, 180 days, 240 days, you're going to start looking a whole lot like we were back during the Russia-Ukraine invasion in 2022. And that's where you're going to start talking about markets being down 20,
Right.
25%, because that's going to start because that length of time that oil prices are elevated is going to deteriorate the economic underpinnings. And so all this idea that we had at the beginning of this year about this reflation trade and economic strength and all this, that's going to go out the window. In fact, what we're talking about right now is my entire newsletter for this weekend,
Okay.
which is laying out the recession risk. And it's all about time. And so the more time that you have of elevated oil prices that translate into higher gasoline and energy prices, the less time you have between now and the next recession.
Got it. So if we have reflation here, which was sort of the
That was
odds
the hope.
on outcome at the beginning of the year, the
Yeah.
longer the time goes on of this conflict, the odds of recession over here perhaps get higher and higher, right? So it's all down to what the duration is going to be.
Well, and also too, remember this whole reflation narrative at the beginning of the year was really faulty. And it was all based on this premise that economic growth was going to come surging back because of, tax cuts and deregulation and the one big beautiful bill. But the areas that were reflating, and you and I showed you the graphs and we've talked about it in previous
Hmm.
shows, is that the areas that were reflating have the lowest rate, as the lowest growth rate of earnings of all the sectors. And we're talking about Walmart and Target growing at 5% a year. And we were selling off the companies with 25 and 30% earnings growth a year. And so the narrative really never made sense, particularly when you match that up to the economic data, which is, employment has been basically unemployment, or actually employment has been negligible at best over the last 3 to 4 to 5 months. Plenty of data showing that the economy and from the consumer side is starting to slow down. And yeah, we're seeing some minor upticks in some of the manufacturing indexes, but those are likely going to be short-lived, particularly now because of what's happening overseas.
All right. Well, it's going to be interesting, and that's what we do this. That's why we do this on a weekly basis, so we can keep people updated here. All I want to say back to you about the war and the importance of that time. I agree
Yep.
with everything you said, Lance. And the longer this goes on, the worse the prospects are for the global economy, the U.S. economy, and the markets. Um, all I'm saying is, don't dismiss the potential of at any point, an hour from now, that President Trump could just say, some people might call it taco, chickening out, but he would certainly call it as, nope, I got everything done, needed to get done, we're out. I think his hurdle for ending this thing is probably a lot lower than most people expect. The moment he thinks it starts to become a net negative for him, I think he
Mhm.
can say, look, the way I define the outcome or the objectives, we're close enough, we're out of there. In his mind, it's better than what we had a month ago, right? So he's going to declare victory and he's just going to move on to the next thing. You know, can that happen here? Look, I know a ton of people are going to say, wait a minute, nope, you broke it. At this point, you bought it. This is going to take a lot longer. There are going to be all these repercussions. I mean, I totally not fighting you in any of that. I'm
Yeah.
just saying, don't diminish the president's potential here to just say we're done.
Yeah. No, no, I look, you can debate this, 9 ways to Sunday, and everybody's got an opinion. If you like the president, you have one opinion of this. If you don't like the president, then you have another opinion of all this. And if you're supporting Iran, you have an opinion. And that's the whole problem with all this is that particularly if social media has just been fascinating to read over the last couple of weeks because people are just spouting off stuff that has absolutely no basis in reality, but they honestly believe that whatever side they're on is the actual factual side. And it's just it's a lot of this stuff is just you have to go back and look at history. I mean, this isn't the first time that we've had these events and where we've had oil supply spikes. I mean, we had, the Suez Canal, we've had the Gulf War One, we've been through these things before, and we know what the outcomes of this is going to be ultimately for the commodities markets and for the stock market. But it's always interesting that every time we get into this, everybody's immediately, oh, this is the end of the world. Everything's going to zero. Interest rates are going to go to 50%. The dollar is going to die. And, and just, it's just fascinating because all we have to do is go back and look at history. And history is a very good guide about what these outcomes are. And so if you just pay attention to history, you'll be fine.
So we're going to talk in just a moment here about private credit, which
Yeah.
again, I'm hearing very similar things, from the social media sphere as well. Again, is okay, this is 2008 all over again, right? This is the Lehman moment. So we're going to talk about that in just a moment. But I got a couple more questions for you about the implications of what's going on with this conflict. But real quick, to the point you just made, Lance, I'm wondering if you're seeing similar things that I'm seeing, which is I am getting more. So obviously, people are very heated about this topic, right? For all the reasons that you just mentioned. It's a very emotional topic for a lot of people. Um, More often than not, I have been getting emails and direct messages on Twitter and things like that of people who are putting a lot of effort into writing me about how they feel and about how it should be how I feel. And how,
Right.
Adam, you need to do, like, this is the time where,
Yes.
men of good character have to do X. And what's so interesting is I appreciate it. I respect it. I don't always agree with what the person is telling me I must do. But for every email I get saying I've got to be doing X in this direction, I've got communications to the other side saying I have to be doing Y in the other direction. People are just really ginned up right now.
No, it is. And what I get the exact same emails. I just had one this morning. And what I've found out that it comes down to after, and this is probably a function of 150 or 200 different emails from different people, and
Hmm.
probably about 50-50 split. It's if there's a slight bias one way or the other, it's very small. But it literally comes down to whether or not you like the president and your feelings about the president. And if you don't, and that's it. And pretty much is like, oh, I completely agree with everything that's going on. We need to do this, this, and this. Go America, right? And the other side is this is all terrible. It's the end of the world. I support Iran, hate Trump. That's fine. But the problem is you're letting that view, in both directions, you're letting that view affect your investment outcomes. So
Yeah.
the hate Trump side is like, I'm out of the market completely. I'm done. I'm out. And that's fine. Nothing wrong with that. But this market is going to rally back very, very strongly here at some point. Might be today, might be tomorrow, might be next week, might be next month. But you're going to get a very, very strong rally that you're going to miss out on because of your bias. Other way around, and it's the same on the other side, right? So, don't let your political biases affect your investment outcome because that's why we're here, right? That's what we're talking this morning is that we
Right.
want to know about money and how to build wealth and how to take advantage of the capitalist system. That's why we're here. So let's not let our political biases affect that outlook for our money. Because money
So
doesn't.
totally agree with you. And I've asked this question a lot over the past week and a half, but I guess I haven't asked it of you because you haven't been on for 2 weeks.
Yeah.
Um, I've been asking people how much of a relief rally, if any, do you expect if this conflict is ended relatively soon? And most people have said, maybe a little. It sounds like you think maybe a little bit more than that. We'll get to that in just a second. But before we get to relief rally, let me get through a couple other things. So when I have you and Michael on, and we'll do this in just a minute,
Mhm.
you pull up the chart of the S&P and we talk about what the technicals are telling us. And when Michael pulled it up last week, we had broken down below, if I'm doing this from memory correctly, the 20-day and the 50-day.
And the 100.
And I asked Michael, okay, so when are you going to start to get worried? And he said basically when it breaks below the 100-day, and the 100-day at the time was around 6,500 on the S&P. We got really close to that the other day. And on the day we're talking here, I think we're in the mid, 6,600 range-ish on the S&P. So my question for you, Lance, is how concerned at all are you with any of the technical damage that's been done over the past week?
Well, so here, let's just share a chart so we're all on the same page because I'm not sure what conversation you and Mike had because I don't listen when I'm on vacation. Um,
Yeah.
but
But my question's a pretty broad one. Has there been any technical
yes,
damage that
there
you're
there
worried about?
has, and this actually goes back to our conversation uh, 2 Fridays ago, where we talked about the article I wrote, talked about this market topping process that we were in. And I laid out that chart of the market topping process and said, hey, we're having this rounded top. And, if we break support the 100-day moving average, that's going to be very important. So this is today's action where my cursor is right now. So Friday, Thursday, Wednesday, Tuesday, Monday, Friday was here's your conversation with Mike. You're below the 100-day moving average. So again, I'm not sure exactly what y'all were looking at last Friday, and I'm not saying anybody was right or wrong, but we were below the 100-day moving average about midweek last week. We took that out, and so that decline, when we took that out, it turned all the buyers that were there into sellers. So all the systemic traders, the algorithmic traders, et cetera, all turned into sellers at that level. So this bar graph on the right hand side, this is volume at price. So this is the amount of volume buying and selling that occurs at any given price structure in the market. And what you'll notice is that right around the 6,900 level is a ton of volume. This is all that cluster of support. Every time markets came down to that 68, 6,900 level, buyers were stepping in. That's why there's so much buying pressure at that level. Now you see where we're down here, there's not that many buyers or sellers. And so buying is a lot weaker here. Sellers don't have any control here at this point. So any rally back up into this previous volume area is where now what we call trap longs. So everybody that was buying at these levels are now at losses. And so when you get a rally back up to these levels, this is going to be consistent resistance now for the next few weeks, because every time you rally back up to those levels, everybody that's losing positions are going to say, "Oh, I'm out," right? So they're trap longs, so they get out.
Yeah.
So we're going to have to get above all that level of resistance and then move back above probably towards 6,900-ish, maybe 6,950 to really start getting the bull momentum back into the market. So we have a good bit of work to do here, but markets are decently oversold on various levels, and sentiment is getting pretty negative here. So again, I think we're getting up into a decent shape to where we're going to get a fairly strong, all we need is one piece of positive news. We get a fairly strong reflexive rally back up to where this 100-day moving average is, which now the 20-day is crossed below the 100-day. So the 20-day moving average is now below the 50 and the 100. So we've got some definite negative downward pressure on the market. That's gonna keep prices contained here for a while until we can start really building some momentum back into the market. So we're in a good position for a rally, maybe starting in the next week or so that goes through April. And then we're going to get into summer, which is pre-midterm elections. I'd expect a lot more chop and volatility during the summer, get through it till we get through the midterm elections, and then a rally into year end.
All right. And so I think I did misremember. I think the thing that Michael had said, he'd really start to worry if we broke there through the 200-day moving average.
Yeah.
Um, and
Yeah,
so,
the
okay.
200-day, the 200-day is crucially big support, right? This is that red line. So
Yeah.
this is the Fibonacci retracement level. So this is the November lows to the highs that we set in January. So this is just a Fibonacci retracement of that rally, and we're currently approaching, the one of the lower levels of that retracement, which is why we should start getting a bounce in here. And plus, that 200-day moving average is sitting right below it. So if that 200-day moving average is hold, we should get a nice reflexive rally up before we come back down to retest the 200-day moving average or start to establish higher lows, those type of things. But then the real challenge is, like I said, is going to be getting above these moving averages.
Yeah. Okay. So one of the questions I've been asking you and Michael and several others is, whoop, no, yeah, just scroll,
I
go
was
back
just trying to
down.
make it a little bigger so that you can see it.
Yeah,
Okay.
but no, you're going the other way. I want the timeline to be wider.
Okay. Sorry.
Okay, so we've been talking about how since basically end of September, start of October, the market really hasn't gone anywhere,
That's
right? And
correct.
so the question has been, okay, so is this a consolidation before new highs, or is this a topping out process? And you'd had those graphs that you'd shown in past weeks where you had put the rounded top on there and said, look,
Right.
don't read too much into it, but we're going to find out whether this is a topping process or not. Obviously, the recent price action makes people think, oh, this looks like it topped and it's now going over. But for you, my assumption is it's all comes down to the 200-day moving average. If that is a support and it bounces, you'll be like, no, we're still in the clear. But if it decisively breaks through that, are you going to then say, okay, look, the risk this was a topping process is now too hard or too high to ignore, and I got to start taking some more defensive actions in my portfolio allocation?
No, no, no. We were in a topping process. We have completed the topping process. We are now in a correction. And we have already reduced exposure. We were near 70% equity exposure in our 60/40 model. We're now down below 60. So we've already been cutting exposure to the portfolio over the last several weeks and rebalancing within that portfolio over time. Because that's kind of what all this market analysis was telling us. And that's one of the big drivers, to be paying attention to, is that we have broken that process. And this is, really important. We go to look at, hold on a second, let me just log in
Yeah.
here real quick.
And while you're pulling it up, let me just ask one question for you
But
to put in your answer, which is you just used the word correction, which is kind of it's a big word for a lot of people when it comes to the stock market.
mhm,
Um, we're only down, what, 400 points from the all-time high.
yeah.
So it's not that much percentage wise. So just explain what you mean by correction there versus most people think, oh, that's a 20% drop in the market is a correction, right?
Well, no, a 20% drop is something more than a correction, but just a correction in price, right? So it's just so if you want to put a milder term on it, we're having a pullback.
Okay, good. I just wanted to box it
Yeah,
for folks
yeah.
so we didn't freak
So
anybody out. Yeah.
but again, so we started, so this is basically our portfolio performance for a 60/40 model over the last several months. And we're right now our portfolio is very slight. Our portfolio is the green line, the S&P 500 is the blue line. And basically there's been very little, we've been pulling back exposure, which is giving us this big gap over the S&P, is because we've been reducing that exposure to the markets over the last few weeks. So we weren't waiting for the correction or the pullback to occur to start taking action. We've been taking that action for the last few weeks. Now we still have decent exposure. We're still running roughly about 57% exposure. So we've reduced exposure by 13, almost 14%, but we're still holding a healthy balance of holdings. And so if we start taking out the 200-day moving average, et cetera, then we'll start reducing that even more. But most likely, as I said, we're going to get a rally first. And on that rally, that's where you want to start taking exposure off the table. You don't want to be selling off your exposure here because the markets are deeply oversold on multiple levels. And so you want to be aware of that you're going to get a bounce here of some sort. You've been down 4 days in a row now, so you're going to get a bounce. Reduce your risk into that rally. So reduce your equity exposure on rallies. Don't panic sell near lows.
Okay, so interesting. Okay, so this thing goes down. Let's say it hits the 200-day moving average. Um, you won't sell until then. If it bounces off the 200-day moving average, you will
Mhm.
start selling more, sort of selling into strength.
Yep.
Um, that's again, because I think you assume there'll be at least a retest of the 200-day moving average after that bounce off of it.
Right.
Um, at what point would you start adding back in, feeling like the coast was clear? Would that be after the second retest of the 200-day?
No, so well, either A, you're gonna bounce off the 200-day moving average, come back down and retest it, or set a higher low, and then turn
Mhm.
up, and you're gonna start getting buy signals kind of across the board. Or you're going to bounce off the 200-day moving average and move back above all those, the 50, the 20, and the 100-day moving
Yep.
average, and clear all those resistance levels, maybe flop around a little bit there, turn on the buy signals kind of really across the board. And then that's also going to be your point to start increasing exposure. So you don't have to necessarily buy bottoms, but you want to start buying when you start getting buy signals kind of
Yep.
all kicking in at the same time. Right now, you don't have those at the moment. But again, things are getting so negative in terms of sentiment that you're getting very close to at least a near-term bounce. And again, that I would use to reduce risk into.
Okay, and I want to keep talking about the good scenario here, but again, just on the other side,
Yeah.
if we punch down through the 200-day moving average and it does not prove to be support, you mentioned you'd continue to sell there. Just talk about that environment real quickly. And I know you can't talk specifically until you're actually in it, but how much would you sell? A little? Would you reduce your exposure a little, or is that a big enough line in the sand where you would say, okay, this is one where, I know your portfolio, you have those quarterly ratchets,
Mhm.
right?
Right.
Yeah.
Yeah, so that if we broke the 200-day moving average with some conviction, yeah, we would probably knock another 10% or 15% off the portfolio. So, I mean, we'd probably make a fairly decent risk adjustment across the entire portfolio all at one time.
Hmm.
Um, but this was the article I wrote on March the 9th, and this is where you and I were talking that following Friday. This was that chart back then where we hadn't taken out those support levels yet.
Hey, you
But
said March the 9th. That was 3 days ago.
Oh yeah, this was Monday's article. Sorry.
Yeah.
This is the one I wrote. Oh, sorry. This is the one I wrote over the weekend. I apologize. I forgot when I was here last with you.
Yeah.
So on Monday I wrote this article, which is kind of going through exactly what we're talking about, is this kind of technical management profile. So we've taken out this 100-day moving average and completed this kind of topping process, and I laid out kind of all these kind of support levels for the markets. And these are the things that we're working through right now technically within the portfolio. So that as we start looking at these, and again, now, we're through all those three kind of primary moving averages. We're now down to final defense, which is to watch that very closely. But again, as we start to see these breakdowns, as I was going through a second ago, we're still okay. We're still in an uptrend. We haven't violated the 200-day moving average. The markets are still trending positively. There's certainly some weakness here, but this was what we laid out with the South Park market view back in January, saying, hey, look, you're going to have some corrections along the way this year. It's not going to be a year like last year where the markets just kind of keep going up. You're going to have these corrections, this kind of increase in volatility. And so that's what we're seeing right now. Markets are behaving very well despite what's going on in Iran, despite what's going on with private credit. The markets are actually holding up really, really well. So you have to give some acknowledgement to the strength of the market because it is looking through, the market is pricing in what's happening in Iran. The market's pricing in what's happening with private credit. And so while there's, lots of headlines and things, I was like, oh, private credit's blowing up everywhere. The market knows this and the market's pricing this all in. That's why the market's down a bit, right? The market is repricing in earnings expectations and risk right now, but it's not being down 10, 15, 20% over the course of a couple of weeks saying, hey, this is a real issue. The markets are saying, hey, this is an issue. It's going to have an impact. But overall, the markets are pricing through this pretty quickly. And that's not going to last forever. The markets are going to price all this stuff in and then start to rebase itself and then start looking forward again.
Hmm. Hmm. Okay, so let me ask you this. So in our recent talks, you've been and this was pre-Iran war or
Yeah.
Iran conflict. You were saying uh, we've had the rotation from growth to value. A lot of value is now hard to call value because the
Yeah.
the multiples have been expanded so much, and some of what was in growth was really looking pretty abnormally oversold. And specifically, you were talking about the software players. And of course, one of the sentiment driving that was, look, it's an AI world, and AI is going to, basically replace the software that a lot of these big companies have built their businesses around. It's going to drain their moats. Um, and we've already had the conversation where you've said, look, that's probably overblown, especially in a lot of these big names, and that this may be a good time to start adding some exposure to that sector while it's so depressed. Now, the conflict has only brought the markets down even more, therefore making something that was perhaps oversold even more oversold now. So, do you still see them as attractive, and is this a good time to start moving capital there, or given what we just talked about, the concerns that, hey, we don't know if this market could actually turn down even further, would you wait before moving capital into that space?
Yeah, well, those stocks. So yeah, we already did. We bought very small. I'm sure Mike talked to you about. Did y'all go through trades last Friday?
We did. And you had actually flagged that you planned to do those trades when you talked 2 weeks ago, and then Mike confirmed that you did them a week ago.
Yeah, yeah. So
So
yeah,
yeah,
we added a small starter position in CRM and ServiceNow, and those have actually been holding up very well relative to the markets. I mean, they're under a little bit of pressure, and I'm hoping they're going to pull back here a little bit more, and they have been over the last couple of days, which is good.
because you want to buy more,
Yeah, I
presumably.
want to buy more, right? I want to get them up to target weights. So, again, that's not, when things get beaten up really bad, they don't go straight back up. They're going to have to churn around for a while. You're going to have to be patient with a software trade. But if you're buying companies based on kind of future values, future earnings, future prospects, some of these companies are really, really cheap. But again, it may be dead money for 6 months or 8 months or a year before they start to work again. Because whenever something goes through a really big corrective cycle like these have, it's unless there's just a complete change of narrative overnight, everybody goes, oh man, we were completely wrong. Um, this is going to take a while for it to work out. So again, you have to buy it on dips, kind of wade through it a bit, and then you gotta give it time to work. These are investments, not trades. So these are things that we're potentially going to wind up holding for 2, 3, 4, 5 years
Yeah.
eventually.
So for the individual DIY investor who's watching this right now, and of course this isn't personal financial advice for them, but if they're looking at the space thinking, oh, you know what, Atlantis thesis, I'm bought into it now. Um, if they were to think about starting to create some entry positions right now, would you counsel, you know what, wait a little bit and let's see what happens with the 200 DMA here before you do that? Or would you just say, look, if this is a long-term position for you, or medium-term position for you, just start nibbling now?
Well, again, this is when it comes down to managing money in a portfolio, you have to really understand your personal mentality, right? For me, I'm unemotional. So I'm buying a stock that I don't care if it goes down 10, 15% from here. It's not going to bother me. I know what I'm buying into, and I know why I'm buying it, and I know what my duration is. So, I mean, I'm looking out 3, 5, 7, 10 years for these companies. And that's what our views are. But if you're the type of person that if you buy something, it goes down, you're immediately panicking, don't buy software stocks. Just leave them alone. Wait for the whole bottom to occur. You're going to miss the bottom by a large margin. These stocks are going to be up 20, 30% off the lows, and you'll still be able to buy them and make money with them. But if you have a really short mentality or really short fuse on losses, don't buy software stocks.
Okay. Um, all right. And I'm going to share something that's a little bit embarrassing. But this theme of software stocks being really, undervalued right now or overly beaten down has just been coming up in like every interview I've been doing in the past 2 weeks. So the other day, in between interviews, I only had a minute or two. I was like, I'm going to add some exposure. And so I just quickly, you know, went to Yahoo Finance and just put in, I'm looking for a software stock. And there was a iShares one, and I just bought it. This software and security index or something like that, right?
IGV?
No, nobody should go do what I just did here, but I think it's XSW is what I bought. And then I looked at it a couple of days later and said, okay, what did I like? Let me research this a little bit. Let me do my research now, right? And I looked at it, and like none of the positions were the positions that I thought it was going to have.
Right.
I was looking for sort of the Adobes and Oracles and
Yeah,
stuff of the
I,
world.
I I don't know this ETF. It's the State Street Spider S&P Software and Services ETF.
Yeah,
Yeah, I don't even know these companies. Adela Circle, I know.
yeah,
OneStream, Clear Secure, Ring Central, A10.
yeah.
Yeah,
Like Ring Central, which is like a tiny. I mean, it's not an Oracle, right?
right. The one you wanted
So,
was IGV.
pardon me.
The one you want is IGV, Indigo George Victor.
All right. Well, thank you. So, anyways, I then pivoted out and said, and found a different ETF that had more of what I wanted in there.
Right.
But the point is, folks, obviously, just know what you own. And a lot of times the names of these ETFs, can be a little deceptive. So don't be so trusting. Now, I knew I was taking a risk when I just sort of fired that bullet on the fly, but I was personally embarrassed, and I was like, oh my God, this thing that I always advise people to do, I didn't do it, and it
Trust
led me to pivot.
Trust me, some of the greatest things I've seen, especially with retail traders, is, there'll be some private company that's doing something. And so people will run out and they'll buy a publicly traded company that has a symbol that looks like that private company,
Sure.
thinking that's the company.
Yeah.
And they run this stock up that has nothing to do with anything. But
We
yeah,
I, we've talked about that on the show in the past. I'm trying to remember some of the companies, but yeah, they're kind of like really near names, right?
yeah.
Oftentimes in a totally different industry. And anyways, folks, too, just real clear, I'm not slamming that first ETF that I mentioned.
No, no, no. It's
It
just
just didn't have in it what I assumed it had in it when I bought it. Yeah.
yeah, no, that's right. That's
Yeah.
right.
Okay, so all right, so we've talked. Oh, real quick. Obviously, a big threat of the Iran conflict is that it goes on for longer than folks would like, and that the oil prices remain elevated for a lot longer than they would like. We just got news, well, really over the past 2 days, that a coalition of nations are going to be releasing oil from their strategic petroleum reserves. And President Trump just announced that he will be releasing, I think, 172 million barrels from the U.S. Reserve. I think all in all, it's around 400 million barrels that's being discussed here. Um, what impact, what relief, if any, do you expect that to provide to oil prices, Lance?
No, nothing.
Yeah,
It's
it's
we
just
saw this.
optical.
Well,
Yeah.
we saw this during the Biden administration. Remember, gasoline prices were spiking during the shutdown, and so we were draining the SPR to try to bring gas prices
Right.
down.
And it made almost no difference in prices.
Exactly.
Yeah.
It's just those operations. I'm trying to find the right word, but those actions, they have very little impact on, because look, markets trade on futures contracts, right? It's just speculators. So whether it's gold or whether it's silver or oil or wheat or lumber or whatever it is, these are just futures contracts. So these are people in the futures markets saying, I think the price of X or Y or Z is going to be this in the future. And so they start buying that contract. And so there's a buyer and a seller on those contracts on both sides. And so the more demand you have for a contract, I think gold's going to go to 5,000. Okay, great. So there's a bunch of 5,000 contracts out there. So everybody's buying those. That moves the price of the commodity up because that's what the futures are doing. So prices of all commodities are based on the futures contract,
Hmm.
not on the actual supply and demand. So when you when you open up the reserves, so great, let's go take 80 million barrels of oil and throw it onto the market. Well, that's today. And the markets immediately know that that's going to get absorbed in 5 days or 10 days or whatever the number is. And then you're back to square one. But the future markets are still looking out, going, this problem, if it exists longer, it's like poly market, right? Everybody's saying, I think the price of oil is going to be this in the future. And that's what sets the oil price. So that's why these actions have no impact because the markets see right through them and they're still pricing out on what they think the futures contract is going to be. And then, of course, you have a whole bunch of people purely just speculating on the price. So when you have a lot of demand for oil contracts to buy, the sellers of those contracts, because again, you have to have a buyer and a seller.
Yep.
The sellers of those contracts demand higher prices, and so that continues to push the oil price higher, or any
Right.
commodity: wheat, sugar, cocoa, gold, silver. It doesn't matter.
Okay. So again, folks, as investors, take these strategic reserve releases with a big grain of salt and look at them as mostly optical things, as things going to really impact the price.
So this is in the newsletter this weekend, but I've laid out kind of three scenarios for the markets, and this is what we're working through right now. Is kind of these three scenarios. How long does this actually take, and what's the impact to markets, GDP, et cetera?
Oh, this is awesome. This is what everybody wants to see.
Yeah. So it's in the newsletter this weekend. So if you want to read it, it'll be in the newsletter.
Okay. I'll actually tweet this image out too once the newsletter's out, because I think this is kind of what these answers a lot of the questions that folks have.
Right. So, okay. Well,
Um,
there you go.
okay. So real quick, so oil is trading around $100 a barrel, the time we're talking here, Lance. Um, what impact is this having on the oil and gas sector, stock market wise? Is this actually beneficial for those companies?
Well, you would think so, right? But the interesting problem is that all these energy companies ran up in price because of the reflation trade. Remember, we were talking about a
Yep.
few minutes ago. So back in January, really in December, January, and February, everybody was running the price of ExxonMobil up through the roof, as an example. And I've showed you the chart before where there was this that oil prices and energy stocks. So if you take XLE and overlay it on top of the West Texas Intermediate crude price, they are historically very highly correlated, which makes complete sense because the revenues of ExxonMobil come from the price of oil. However, over the course of the last several months, really December, January, February, there was this kind of retail trade to buy energy staples, utilities, and we just drove the prices of energy stocks well above the underlying commodity. So what's happened is that since the oil price has spiked up, the price of oil has spiked up, but that's really only counterbalancing the forward valuation of of ExxonMobil as an example, which got really overvalued in January and February. So ExxonMobil hasn't gone anywhere really since mid-February, despite the spike of oil prices.
Hmm. Interesting.
Here,
Um,
I'll show you a chart. I'll just real
well,
quick.
it's interesting. Well, no, I mean, you were telling us every week for the past 2 months that that the for the oil sector, it had gotten dramatically overbought in the near
Mhm.
term. And I guess essentially this is sort of proof of it, which is that, hey, a 30% increase in the price of oil has had kind of no impact on prices because they're burning off their overvalue, their overbought nature,
Yeah,
right? Yeah.
which was really it was quite fascinating that again that big run up in energy stocks at the beginning of this year. We were all kind of sitting around our office going, "This doesn't make a whole lot of sense," but okay, it is what it is. So
Okay. So this is a little hard to do because we're trying to prove a negative. But had the conflict not happened and oil hadn't spiked to $100 a barrel, would you have guessed that oil would have sold off? It would have had a big sell-off moment at some point because it had
yeah, yeah.
gotten so overbought?
Yeah. No, it was going to correct. ExxonMobil energy stocks in general, had gotten extremely ahead of their underlying valuation. So they were going to correct at some point. It was just a function of time. It kind of got into a bit of the meme trade. We had a lot of retail traders kind of chasing that trade, buying
Hmm.
oil ETFs, et cetera. So you just had a big surge of push into those companies. And again, the energy sector makes up 3% of the S&P 500. So when you have a lot of investors buying ETFs, it's a very small market. I mean, ExxonMobil has a market cap of 643 billion. I mean, doesn't take a lot to move that stock.
I know. It's
Um,
amazing where that used to be the big kahuna, and now it's
yeah,
tiny compared to the big AI hyperscalers, right?
exactly. So, but again, when you have 3% of a sector in the ETF, it's easier to move. And so we saw a lot of that momentum chase in January, February. So that was eventually going to correct. It was just a function of time. What the only thing keeping it from happening now is that oil prices have come up. But if oil prices correct fairly significantly at some point, that correction in energy stocks is going to happen.
Well, so that was my follow-up question here. So let's assume your most likely scenario happens. This war ends within 30 days. Um, I, I was going to ask, would you then expect oil to sell off as oil sector to sell off as the price comes down, or would it be another sort of jujitsu where like, okay, it's burned off the overbought nature, and now the reflation trade is kind of offsetting the decrease in oil prices? But it sounds like no. It sounds like you would expect
Well,
the sector to sell off.
again, you're playing with a little bit of market dynamics and market psychology here
Yep.
again a bit, but in kind of what you would expect is we have a very sharp retraction in oil prices that energy stocks are going to come under pressure if that occurs.
Okay.
Now they'll stabilize at some point. So, for instance, if you're looking at ExxonMobil trading around $154 a share, potentially it trades back to 125-ish.
Hmm.
So, but that again, that would just put it back into its normal kind of growth trend.
Okay. All right. Okay, now we're going to make our way to private credit, but I want to get there through the sovereign credit market for a moment. So we've had this, you know, pretty big military conflict in the Middle East, right? U.S. carpet bombing Iran, it's a pretty big deal. Historically, you would expect the 10-year yield to go down as global investors had a flight to safety.
No,
No, you disagree with
no,
that presumption?
yeah, no, no. Historically, whenever you have a inflationary impulse and a jump in energy prices, yields rise.
Okay. I mean, I'd love to have the data in front of me, which I don't. But is it safe to say that in most large conflicts, military conflicts, you usually see the 10-year yield go down? But in this case, you're saying because of the oil issue, it's inflationary and that's winning out?
Well, no. So in most normal conflicts, you're going to see interest rates rise initially, right? Going back over time. But what you also see along with that is you see a flight to the dollar. So you're going to see a big, strong rally in the dollar. Interest rates come up a bit because there's concerns over a variety of things that occur because of the war, right? Slow down to the economy, a whole variety of other issues. So you'll get this bump in rates. Now, also, you and I were talking 3 or 4 weeks ago, and yields had gotten below 4%. And I said, look, yields are below 4%. We're very oversold on yields. We're going to get a reflex rally and yields back up to 4.2. All you need is a catalyst. Here you are, right? We're about 4.2.
Yeah.
So yields have really
4.3 on the day we're talking, but yeah.
sorry. Yeah, 4.2.
4.3 on the day we're talking,
Yeah,
but
yeah,
yeah.
yeah. So yeah, but that reversal in yield, all it needed was a catalyst, and so a spike in oil prices, which has an inflationary impulse into the economy. I mean, immediately everybody goes, "This is going to push inflation back up to some degree." So you would expect yields to come up here a bit. Again, all you needed was the catalyst. Though yields were so oversold when you were below 4 that you were
Hmm.
going to get a rally back in yields.
Okay. I would just suggest, and you obviously do what you want to do with your energies, but I would suggest this might be a good article for you to write, since you write articles about absolutely everything.
Right.
Um, because this idea of war means lower treasury yields
Mhm.
is something that I think most people watching this video, I think they have that heuristic in their mind. And a number of people I have talked to since the war, I've interviewed since the war began, have brought this up as an anomaly that surprised them.
Mhm.
So it sounds like you're saying, hey, it's not an anomaly if you look at the data. It'd be great to actually see, maybe a chart comparing previous outbreaks to see what
Yeah.
happened to show that this is the norm, not the anomaly.
Yeah, yeah,
Yeah,
I
I
can come
think I
back to
think
you.
that would be very well read, and very folks would find it very interesting. But okay, so now let's move into the private credit side of things. So you may remember 2 weeks ago, I brought up, some of the mounting issues that we were seeing in this space, and I asked you, what was your level of concern about private credit right now, and how much smoke was there? And if I'm remembering correctly, you said, "Hey, I think that there's some real smoke there. We just we're not seeing enough yet to feel like we can declare this as like a big problem,
Mhm.
but there's highly likely to be some bad things going on there, and it's just going to be a matter of waiting to see how bad, whether it's going to be small, medium, or moderate, or sorry, small, moderate, or severe. Um, since you and I talked, we've seen a number of more firms gating distributions, even some really big Wall Street names like Morgan Stanley. Um, you probably know this better than I, Lance, but it seems like Blue Owl, which has really been getting beaten up, is perhaps now fire sailing some of their assets. I've seen that term mentioned in headlines. JP Morgan has stopped basically lending to private credit firms. Um, so I've got a couple more questions around this, but I'll pause here. What is your current assessment of what's going on here? How mild to moderate to severe do you think it is? And really, at the end of the day, what type of risks does this pose to the folks that are saying, "Oh my God, this is the new subprime. This is the new thing that's going to take the whole system down with them." Um, do you share those concerns, or would this be more ring fenced if it got worse from here?
So, very different than subprime to start with. So, I just wrote an article today. I just published it this morning on private credit. Um, Went through and did a whole bunch of a kind of a deep dive into kind of the different aspects of what's happening with U.S. private equity, private credit, what's been going on, kind of what the impacts are across the board. So this is what we're going to talk about here is just I did a deeper dive into this and went like here's BlackRock, here's Cliffwater, here's Morgan Stanley, here's J.P. Morgan Chase, what's been happening, and this is ultimately who's going to get culled, who's going to survive out of this. The mistake that people are making by going, oh, this is the next subprime crisis, is that you have to remember the subprime crisis wasn't just about subprime loans. The loans were there and the loans were bad, right? We were doing ninja loans, no money down, no job, no income, no credit verification, whatever. But it wasn't just the loans. It was the fact that we were doing derivatives of derivatives of derivatives off those
Hmm.
loans to the tunes of trillions of dollars. There was just
Right.
so
And we
many of
were
these.
packaging those loans and everything. So
Yeah,
even the AAA tranche had some of these crappy loans in it, right?
exactly.
Yeah.
That's not the case with what's happening on the private credit side. It's not, and again, when you think about a firm, just talk about BlackRock as an example. So they gave a $20 billion fund as an example. This is a $10 trillion asset firm, right? This is a rounding error for them. The whole fund could go to zero and they're still at
Yeah.
$9.8 trillion, right? So, this is a very the size of this is certainly concerning, right? I mean, it's certainly going to impact investors. But this is on the private side of the market as well. So the people that are going to lose money, these are private investors. They understood the risk going into it. This is why I've been a huge pushback against putting private equity, private credit. I've written multiple
Right.
articles on
Why am I
private
so
equity,
lucky?
private
Yeah.
credit. Don't get into it. Don't buy it. Don't put it in 401k plans because you don't have this ability to A, understand what your risks are, and B, go through the liquidity issues, right? Where you don't have liquidity. And so a lot of these investors, just because the fund gated their investment, all that means is you can't get your money out. It doesn't mean the fund is failing, right? It just means
Right.
you can't get your money out. The reason they gated the fund is so that you can't go force them to sell assets at a deep discount that would impair all the other investors. So they're saying, look, give this time. Most of these loans will, we think most, this is what they're saying. We think most of these loans are going to be fine. But if we have everybody redeem all at once and we have to redeem all this money, we're going to destroy the underlying
Yeah,
investments.
it's the run of the bank problem. So
Correct.
just to be super clear, gating doesn't mean that particular fund is in danger of going to zero soon.
Right.
but it also doesn't mean that it might not be,
No,
right? I mean,
it could. Yeah, it could. Sure, absolutely. If they've got, but again, this is what you and I have talked about earlier is that these funds had so much money thrown at them over the last few years. There was just all this money coming into the markets from everywhere. And people were like, oh, look, private credit. And I can't tell you how many calls we got, how many, inquiries we got. How do I get into private credit? How do I get into private credit? Well, when you have all that money flowing into it, and as we talked about before, there's only so many good deals, right? There's some really great private credit loans out there, right? They're fantastic. They are going to pay off. They're going to be great. But when there's a whole lot of money, you've got to start coming down on your kind of your risk requirements, going, okay, well, this loan's not perfect. It's okay. I'll do that loan. Well, this loan's not that great, but I need to do a loan, so I'll do that loan. And you kind of keep coming down in these tranches and doing worse and worse deals until you get to this problem where you've got a fairly good amount of bad deals that are out there. And eventually, when that happens, some of them are going to start blowing up, and that's what's happening here. But this is not going to transpire most likely into another subprime crisis event because most of the banks are pretty well shielded on this. And this isn't going to create a counterparty trading risk like we saw during the subprime crisis.
all right, Lance, I want to dig into that real quick. I just want to try to clarify something you just said there. So we've talked about this before, uh, more in the context of like private equity and even venture capital is what tends to happen is you have kind of a hot sector, right? Private equity, venture capital, private credit, whatever,
Mhm.
and firms start chasing the opportunity there. And what starts to happen, as you said, is um, there's no like the number of deals increase. Oh, there's players in the space who are willing to give me capital, right? Whether it's equity or whether it's debt. Yeah, I'm gonna try to create a deal and try to get it funded, right? And the challenge is as the number of deals increase, the number of good deals don't.
Right.
um, and so what tends to happen is the white shoe firms, like the best of the best firms, they tend to get first review of all the deals. And they're like slam dunk, no brainer. This deal is going to be a 10 bagger. They fund those and they generally lock those up. And so all the other deals then have to go to the next tier player, right? And if they get refused from there, they go to the next tier player. And there's all these firms that have, entered this space or been created to be in this space. To your point, they need to be doing these deals to be in business. So they start making kind of worse and worse deals. They start lowering their standards because they're like, well, if I'm a private credit lender, I got to lend, right? And it all works while everyone's super excited about private equity or private credit or venture capital or whatever. But when the worm starts to turn and people realize that either the performance isn't there or some of these loans start going bad or whatever, you realize that kind of the old Warren Buffett thing of you find out who's swimming naked, and you realize that a lot of these players were making a ton of loans or putting equity into companies that probably had no business of doing so. And so there's a culling that goes on. This is sort of it's almost a cyclical thing that happens in these sectors. And I did read your piece this morning, Lance, and it sounds like a lot of people in the private credit sector are saying this is a culling. Like this is not just going to be a couple firms having some trouble. This is going to be a multi-year process of kind of the Darwinian process of just letting the dead wood burn. And you have your little chart in there of who's going to survive and who's likely not to. And it seems like the Blackstones, the BlackRocks, like they're going to be just fine, right?
Yep.
But everybody increasingly below them, that's where you're going to start seeing the bodies start to float to the surface, correct?
Absolutely. Well, and this is what we went back talked about previously about private equity is that when somebody comes to you and says, "Hey, Adam, I got this really great private equity investment for you, that you need to take advantage of." The first question is why are you coming to me? Because if this is a really good deal, the BlackRocks, the Blackstones, the Sequoias, those big giant KKR, those big giant
Apollo,
private
yeah.
equity firms, they're going to take it and fund it immediately because they want those types of deals. So, so a lot of those private equity, private credit deals on that lower tier, they are going to go away. And there's going to be a lot of retail investors, unfortunately, that got into these that are potentially going to lose some, most, or all of their money.
Their money. Oh, okay. So what I'm
Or at worst case, that's worst case,
right.
you may be locked up in these things for 10 or 20 years trying to get
Mhm.
your money back.
Mhm.
So that's the other problem.
Okay. And that's obviously on the bad end of the scale.
Yeah.
Now, what I'm curious about is sort of the contagion here outside of just the private credit firms who made loans that they shouldn't have made, right? So there's probably a fair amount of the junk private credit in like pension funds. I'm guessing on this one, but I imagine so. Um, uh, you know, uh, you've been able to buy some of these private credit deals in the public markets. So, like, I reached out to Stephen Bavaria, who I've interviewed on this channel in the past,
Yep.
who's got his whole income factory, framework. And in there, he would invest in BDCs, right? And he would invest in like the Apollo BDC ETF, right? And so I reached out to him and said, "Hey, what's going on, and how is your portfolio faring here?" And he said, some of the names have been hit pretty hard, like the market value of these ETFs are down, but he's in the larger guys like you're talking about, Lance.
Mhm.
He's saying, look, these things are still paying out, and that's the whole reason why he builds the income factory. He's almost sort of agnostic at what the market value of the portfolio is at any given time, because what he cares about is how much income is it bringing in every month, because that's what he's depending on it for. And he said, actually, in some ways, this can be looked at as sort of a positive where these managers of these BDC funds they're still acquiring,
Mhm.
and now they're acquiring at lower valuations. And so if and when the sector heals, you're buying at value right now, and you may get not just continued income going forward, but you might actually get some nice appreciation in the long run from this.
Yeah.
Obviously, TBD if that's going to happen, but there are a number of people that bought these funds publicly who are now looking at their portfolios going, "Oh my God, this thing's just been whacked," right? So I don't know what that impact is, but it's another potentially
Yeah.
injured party. But then the third one, and I'm more interested about this one,
Sure.
is the banks. So I mentioned that JP Morgan has stopped making loans to private credit lenders. And look, JP Morgan, they're one of the behemoths. They're going to be fine probably no matter what happens. But I got to imagine that there's a lot of banks that have not made private credit loans themselves, but they have loaned to the private credit lenders. And
Mhm.
what is their level of exposure? Do we have any idea around that?
Not well. We'll know when earnings season comes around when
Yeah.
they discuss their loan loss reserves. But look, J.P. Morgan's got exposure, BlackRock's got exposure, and those stocks have come down. We're looking for an opportunity. I mean, we're going to be buying BlackRock and J.P. Morgan and Goldman Sachs on this dip, right? Because these companies are not going to go away. And again, take a look at talk about BDCs. One of my favorite BDCs is Main Street Capital. And yeah, it's had a decent correction here. And you go pull a 30-year history on it, you can't even see the blip, right? It's not even negligible. It's negligible at best. But those are opportunities where you can start acquiring good companies at cheaper prices. The interesting thing, Adam, is that we're supposed to be investors and we're looking for opportunities to buy capital or put capital to work at cheaper prices. But when things get cheaper, we keep coming up with all these reasons like, oh my gosh, this is the next crash. Everything's going to zero. I got to get out of the markets. Have you heard this headline? And generally those are terrible things to trade off of. And it's more important to look at the fundamentals of these companies. Are they earning money? What's their cash flow look like? What's their debt structures look like? And figure out what their total risk exposure is in this event relative to their total business. And when you start looking at companies like JP Morgan, Goldman Sachs, BlackRock, Blackstone, it's a rounding error in a lot of cases.
Okay. So two questions on this. So one is um, for the highly likely to survive cohort,
Mhm.
right? Which we'll call well, I'm trying to resist saying too big to fail, but it's you know the names when I mention that, right? It's the names you've already been mentioning, the BlackRocks, the Blackstones, Apollos, et cetera. Um, this may be a good opportunity to buy well-managed assets of theirs at attractive valuations, right? So to your point, this could actually be an opportunity for the discerning investor in this space. Um, that's a plus. On the other side, what I'm still just not clear on, and maybe you aren't either, is just so forgetting the JP Morgans of the world, but going down to some sort of mid-tier banks or the thousands of regional banks in the US, could this be a contagion risk where we're finding, just like a lot of them were overexposed to commercial real estate, maybe a lot of them were lending to private lenders, and that's going to come back to potentially seriously impair some cohort there.
Well, yeah, there's certainly going to be some fallout. But look, I mean, the commercial real estate is a great example. Go back 4 years ago, and it was like, oh my gosh, we shut down the economy 5 years ago now. We shut down the economy. Nobody needs an office space anymore, right? And we had the conversation back then that I had gone to a commercial real estate conference, in Milwaukee, right in the middle of that. And all these commercial real estate guys were buying buildings at 20 and 30 cents on the dollar so that JP Morgan, as an example, they could get the building off their books. And these private equity guys were buying these buildings at 20 cents on the dollar, and BlackRock was funding them all. So, there was this, everybody was assuming like, oh, this is going to be devastation to the real estate market. It's going to collapse the markets, and didn't. I mean, you didn't even have a blip on the radar because of commercial real estate. Very likely, this is going to be very akin to that, which is it's going to make a lot of headlines, lots of thunder. It's great for videos and for people to get clicks and views. But at the end of the day, this is not that big. It's a significant issue, but it's not the type of issue that's going to bring down markets.
Okay. I put this note here, maybe it's not even super relevant, but given the worries that we're seeing right now in private credit, is there any potential reason to map that to the margin debt situation and just think
Different leverage.
it's a different type of leverage, but does it make the margin debt leverage any more vulnerable if private
No,
credit's
I
starting to
can't.
come down?
As far as I'm aware, I can't buy a private credit fund on leverage on margin.
Yeah. Um, yeah. Okay. Like I said, it's probably pretty tangential. You worry if you have two kind of
No, you
dangerously levered environments, right?
well, no, let's, oh, that's a different conversation.
Yeah.
Let's back up for a second. Is there leverage being used in the private credit market? Absolutely. Is there leverage being used in the stock market? Absolutely. Is there leverage being used by retail traders who are buying triple levered ETFs with options on margin in an account? Yes. You know, there is a lot of leverage in the market. So there is risk that if something occurs, and again, you kind of go back to that table that I was showing you earlier, if this market drags out and we start to really crack serious support levels in the market that starts forcing margin calls, now you got a problem with leverage.
Okay. But we're not seeing those signs yet.
Not yet.
Yeah. Okay. All right. Let me start wrapping up here. One last major topic. We don't have to talk about it too much, but one of the things I'm finding myself talking with folks on this channel about a lot recently is the jobs market and really trying to make sense of it. Because there are definitely data sets you can look at and say, hey, this market is not looking very good. And we just, the latest payroll numbers that came out a week ago were a massive surprise to the downside, right?
Mhm.
This was the negative 92,000 payroll report, right? Um, but then we got the ADP report after that. It was actually pretty good. And I know we've talked in the past that we like ADP more than we like payrolls because ADP is more, tracking what actually happened versus a whole bunch of BLS,
BLSBS.
BLSBS, yeah. Um, so, and this is a BLS number, but like the latest initial claims numbers look fine, right? And I've started to see articles to say that, hey, we're seeing some signs that the no hire, no fire economy is starting to become the some hire, no fire economy. So, I'm seeing some analysts seeing green shoots. I'm seeing some still saying, hey, and you just said yourself, hey, the employment hasn't gone anywhere. And if you look at the consumer side, things are still looking like they're maybe had momentum's to the downside. From your perch right now, do you have any more insight into where you think employment is headed this year?
I think employment's going to be fairly kind of just stagnant. Again, we're one thing that we are seeing, and you and I have talked about this before, is that AI is costing some jobs already, right? We're
Right.
seeing companies going, I don't need to hire as many people because I can do this job with AI or whatever it is.
Right.
I think that may be more the story this year is that it's not a terrible employment economy, but it's not a fantastic one. It's
Yeah.
just kind of kind of kind of a muddle through economy
Mhm.
this year, so to speak, more than anything else.
Okay, but it's not a unemployment spiking, the job
No,
scenario falling off a cliff.
unless unless this we have oil prices above $100 a barrel for 6 months. That's
Right.
going to be
But that's a change that would be a change in the status quo, right?
yeah,
So
exactly.
until the
Yeah,
reflation trade is officially killed,
right.
you're not worried about runaway unemployment.
Correct. Not right now.
Yeah.
Right. But
Yeah.
again, everything's subject to change.
Yeah, yeah. Well, we'll keep going on this, folks. But again, this is one where, I was very bearish about where things were headed unemployment wise. I've started getting a lot less bearish coming into this year. In fact, probably net bullish, on taking the over on economic growth. And like you, Lance, I would normally say, and I think that would mean actually the jobs market's going to firm up even further. But with the whole AI uncertainty here, I'm not willing to say that. And I'm not taking the Iran conflict into account at all at this point in
Right.
time. Right.
Yeah.
Yeah.
No, look, I think AI has a definite impact. But like today, look, we saw JOLTS openings this morning, the job opening labor turnover survey. Job openings had a very big jump. They were like 6.9 million job openings. Now, again, you got to take those with a grain of salt, right? But it does suggest that there are people out there at least, trying to hire some workers.
Well, and the administration's actually been pretty vocal about this recently. Like there are a lot of manufacturing data center, let's build factory jobs out there right now. Will that continue? Of course, that's the administration's plan. But it's interesting, like going back to the what's going on with Iran. Um, uh, it's so interesting all the different sort of unintended consequences here. So, Iran tax everybody in the region, and now all of a sudden, all the Gulf, states are now jumping, wanting to jump on Team US and Israel, which is kind of crazy. Now you've got these Gulf countries that are now sort of allying with Israel against Iran, which I don't think was on many people's dance card,
Right.
even just a year ago or even 6 months ago. Um, but one of the unintended consequences of that is now these countries have taken some damage from Iranian ballistics and apparently are now telling the administration, yeah, I told you I was going to give you $1 trillion in capital this year to invest in your country. Well, I'm still good for it, but it's going to take a while now because I got to redirect those funds to rebuild here. So it's going to be interesting to see, if that impacts any of the growth assumptions that the administration's been trying
Yeah.
to sell us here. Yeah.
Yeah. Agree.
Okay. Let's see here. Trades. So Michael went through your trades last week. Have you made any since, or are you now just sort of letting what you did last week ride?
We're just kind of sitting where we are for this week. I mean, we have some other trades kind of lined up here. And, if we need to reduce exposure, our next move is not to buy. Our next move will be to sell exposure on a rally. So we'll probably just go through most of the portfolio, trim off a quarter point here, a quarter point there, just kind of reduce that exposure as needed on a rally. We really like our positioning setup in terms of we've got a nice split between value and growth, and that's been helping the portfolio really kind of outperform the overall market. So we don't need to make, the balance is right. We just need to kind of tweak around the edges a bit.
Okay. All right. And I did mean to congratulate you when you put up that chart earlier of your relative performance versus the S&P. So congrats. I mean, as somebody who is putting his organization's brand at risk by saying, "Hey, I think RIA is good guys to work with." It's always nice to see,
Yeah.
validation of that. Um,
Oh, that though, we like to keep our clients, so it's important that we try to provide them good performance.
right, and again, too, nobody's always going to be beating the S&P,
Right.
but what matters more to me is less that you beat it when things are great. It matters to me a lot more when the S&P
Yeah.
is struggling, that you're not struggling as much as it.
Right.
So, again,
That's our philosophy is 80/20, which is 80% of the upside, 20% of the downside. So that's what we try to work to.
right. All right. Well, anyways, congratulations on how this year has begun for you. All right. So we'll get to a quick rant and then we'll head up. We'll head out. Uh, So I've got an interview coming out tomorrow that I think a lot of people are going to find really interesting. It's one of the more interesting ones I've recorded this year. It's with a guy named Peter Alexander, who is a China analyst that Luke Groman put me in touch with. And Luke had proactively reached out to me after I had got to meet him in person down at Stephanie Pomboy's Florida conference, and just said, "Hey, Adam, this guy, like I talk about China a lot. It's a big part of my overall global macro view. And the guy that I get all my China insights from is this guy, Peter Alexander. He doesn't do too many of these interviews, but I think he'd be a great guy for you to talk with." So reached out to Peter. We hit it off. Turns out we're both guys from the same age. He grew up in Connecticut, so we got a lot of similarities there. But he's much smarter than I, and he's been living in China for 30 years. So, a lot of the folks that I talk with about China on this channel, kind of study it, but they study it from afar. Peter's been inside it for the past 3 decades, and just a really great deep dive into how China works, what China, what its likely ambitions are. And in many ways, this may actually surprise a lot of Westerners. So a big part of the discussion was sort of like, what do Westerners have right about China? What do Westerners have wrong about China? And I think it's a very important but very fascinating discussion, and I highly recommend that everybody watch it. It's going to come out the day after this video airs. But one of the questions that I asked him was, because I went to a tiny little coastal slice of China back in the mid 90s. So I haven't been to China myself in many, many decades. But a lot of the people that I talk to who go there, Westerners, they come back and they say like, oh my God, like coming back to an American airport or getting on like an American railway system after having been in China is like returning to a developing nation. Like they're just so far ahead of us in terms of the infrastructure they've built, its quality, how well it's maintained. And I asked him if that was true, and he said, yeah, it really largely is. It's one of the things that China's just really invested in, done really well. They've obviously really invested in educating a whole bunch of engineers in their country, and we've all seen the videos on social media where China decides it needs to build a bridge, and you can watch that bridge get built in fast motion, where they build it over the course of like 72 hours, right? Where in America, it would take you 7 years just to get the permitting approved, right? And it would come in way over time and way over budget. So anyways, you should go watch that China video, folks, when it launches. Reason why I mentioned that specifically is because, someone living here in America, like I think I mentioned to you, Lance, well, of course I mentioned to you, I moved from California to Nevada. And, in my early days here in Nevada, I was driving around and I was like, this like, it's really well maintained. The roads are great. The infrastructure here is just fine, if not better than California. In fact, in many cases, it's better. And I thought about like, California's justifications for why they needed to charge the highest state income tax in the nation. And it was always, well, we have to provide all these services to you. Right. And I'm like, all right, well, I'm over here in a 0% state income tax environment, and the services are plenty good, even better in a lot of cases. So obviously, it just belies the management of how we're choosing to manage. And you've heard the whole phrase of decline as a choice, right? And I think in a lot of ways, at the national and state level, for too long, America has been, in certain areas, choosing to decline. And hopefully, we've got some momentum in trying to reverse some of that stuff now. But here's the rant. So when I do these videos, Lance, when I do my introductions, or if I do a short explainer video, which I haven't done in way too long, I use a teleprompter. And my teleprompter is just an iPad with a teleprompter app on it. And I bought an old iPad a few years ago, and I've just been using it solely for that. I don't use it for anything else. Well, anyways, that just basically stopped functioning. The app wasn't updating anymore. It wasn't pulling in the new documents that I was creating. And it took me a little while to figure out why. And basically it was because to continue to work, the app needed Apple's latest operating system. The problem was the iPad was so old that it couldn't accept the download of the new Apple operating system. And so basically it was a it was just a brick. I now had to go out and buy a new iPad. And of course, this is important to my livelihood. So I was like, all right, I'll go buy a new iPad. So I went down to the Apple store and said, look, give me your cheapest iPad, which they did. And it wasn't very cheap. Um, I told them, look, I'm only getting this thing for one app. So do you mind if I sit here and set it up and test it in the store before I leave to make sure that this is actually going to do what I need it to do? And the guy said, yeah, fine, go sit over there. So I started going through the like setup process for the iPad, which again, all I needed to do was just put one app on it. Well, I don't know, half an hour in, this thing is still hung up on this update thing it's supposed to do. And I've called the guy over and he's like, no, this should just take a few more minutes, just be patient. So after like 45 minutes or so, I was like, dude, this is just not updating. And the guy was like, oh yeah, I guess so. Well, let me go see what I can do. Maybe I'll get you a new iPad. Maybe something's wrong with this. He disappears and he comes back in a bit and he says, oh, the sales guy told me this is a known issue. And we got to basically hook it up this way to make it work. Because if you try to do it the normal way, there's a server error and whatever. And I'm like, well, then why didn't the sales guy warn me about that when he sold me this iPad 45 minutes ago? Like if I had taken this home out of the box, I would have hit this exact same issue and I wouldn't have known what the hell to do with it, right? And it's not so much like a planned obsolescence thing, although of course with our digital devices today, that seems to be the de rigueur, which is they intentionally build them to break down. But whether it's deliberate or whether it's unintentional, the fact that we just have these things that we depend on that just essentially stop working for us, and then we have to go basically replace them way sooner than we would like to. And then even then, they don't necessarily work the way they're supposed to, even on the darn setup process. Um, it just got me really frustrated about this again, kind of like both planned obsolescence and also just sort of like the decline of service, right? The sales guy would sell me this thing that he knew had a problem with it, didn't bother to tell me about it, and just sort of tossed me over the wall after he took my money. It's I guess I'm just ranting. This is a true rant today, but this seems to, I mean, I feel like I could say this about, some of the health services that I've received or, products that I bought through Amazon or whatever. Like it seems to be pretty pervasive. And so anyways, that's my rant. I'm sure you probably had similar things happen to you.
Oh yeah, no, and look, I think it comes down to the organization and how you motivate your salespeople. So, like for instance, in our company, we compensate our people very, very well. We treat them well, and so we provide a very high level of service to all of our clients, high touch, high service. Um, Good example, yesterday, my wife's car is was on its last leg, and so we went down to the used car dealership to buy a new car for to replace her car, and she found the car she wanted. And but it's like I'm not sitting in a dealership for 6 hours to buy a
Yeah.
car. It's just not happening. And I told the guy, I said, I'll buy this car. I'm going to pay cash, but I'm not sitting here for 6 hours. He's like, don't worry about it. He said, let me get up, just let me get some information from you. I says, I'll prepare all the paperwork. I'll drive it to your house. I'll bring you the car and we'll sign the paperwork at your house. And I was like, cool. And that's exactly what we did.
That's pretty
But
amazing. Yeah.
yeah, yeah. But the whole point is that that's the way, I think service really comes down to the person. And if somebody's really passionate about their job, they will provide good service. If they're just there to earn a paycheck, it's going to happen. What happened to you is going to happen, right? It's just like, oh yeah, 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 I'll sell it to you, and here you go, and then not really provide you any service. But yeah, I think it's just it's part of the culture problem. That's happened over the last really kind of 20, 30 years. Is used to be, when I was growing up, we were taught to provide good service, right? That was just, if you're going to sell a product, you stand behind your product and you guarantee your product. That's just the way everybody was raised. And today it's just not that way anymore. It's just like, oh yeah, yeah, here's my job and here's your product. Go away. Don't bother me.
Yeah, so totally agree with that. Been a huge degradation in service in general. What I find somewhat shocking in this example is I think Apple is looked at as one of the highest touch services that are still out there, right? You go in there and everybody's got their blue shirt on, and there's the Genius Bar, and I mean they try to overtly, show that hey, we're taking customer service really seriously. And look, folks, I've had good experiences in Apple stores too,
Sure,
so
sure.
part of this is just me being angry.
No, no,
But
it
my
just comes
point
down
is
to the person.
to your point though, like this is our best, and our
Yeah.
best isn't all that great, these days, right? Yeah.
Yeah.
Now, I mean, in your case, I get when you're buying a top of the line Bentley, you're going to get,
Yeah,
the top
exactly.
treatment. Yeah.
Used, by the way, a used Bentley. Yeah, right. Yeah, right. But
Yeah.
with my 1976 pickup truck, I don't have those problems. I just fix it myself.
Well, exactly. I mean, look, that was an era where you could fix your, I mean, that's, I mean, it's almost unimaginable now to have a product that you can fix,
Yeah,
right? So cars obviously have become so computerized. There's so many things in there that you really can't fix with anymore. A battery car, it's not like you can get in there and tinker around with a battery, right?
yeah, that's
And
right.
most consumer electronics these days, not only do not people not know how to fix them, but they've gotten to the point where, if a 2 cent component breaks in the thing, if you can find somebody to repair it, which is almost impossible, the repair job is going to cost a lot more than just going and buying a new
Yeah,
piece of crap one, right? And so we sort of have this, Charles Hugh Smith calls it the landfill economy, but we've got this
right.
really frustrating, yeah. And a big issue too, and it's kind of tied to this, is shadow work, which is like, and my example was kind of a good example of this, is, if you buy, especially a new digital product, like generally you've got an hour or sometimes more of setup process to do to get it to work. And if at any point in time, if it stops working, you're sent a bunch of FAQ stuff that you yourself have to go through. So they basically offloaded the IT service onto the consumer, right? Which
Yeah.
is so frustrating when you don't want to have to be an IT expert and you just want the product you bought to work,
Oh,
right?
no, no, no. That's a huge complaint. I used to buy Dell computers all the time for my business, and used to be their service was really great. And now you call them, and it was like, okay, well, you know, uninstall everything on your computer, reinstall everything, and you have to go through all these jumps and hurdles before you can even get to a guy's, okay, I'll come out and look at your computer, right? It's just environments have changed. And again, nobody's in America either. Everybody you talk to is in India somewhere.
Well, and that's if you can get somebody to talk to you. This drives me nuts, which is, when I was uh, in business school, my summer job was being a consultant, and we had to get company intelligence, and so you would call companies, and you would say, "Hey, can I talk to somebody in this department?" And then you would interview them about whatever, right? It was back in the day when you get a live person on the phone. I mean, nowadays, forget about trying to talk to a company, but I mean, I would challenge you to go to a company website and actually find a phone number. And I'm talking about like Fortune 500 companies, right? Um, I used to work at Yahoo for a long time, and I remember, years ago, 7, 8 years ago, wanted to be like, oh, let me call somebody at Yahoo and ask this question, right? And I couldn't even, the people who, the receptionists that used to sit in the lobby and answer phones, they don't exist anymore, right?
Mhm.
So, you have to kind of, I don't know, you got to go to LinkedIn and basically try to, send a Hail Mary email to somebody to try to get somebody to respond. But you literally can't get people to talk. Even my local bank here, if I want to talk to a person, I have to get in the car and go down there. If I call the bank, I'm sitting in this endless phone tree that ultimately drops me off at some automated answer at the end, And you're like, oh
Yeah.
my God, you guys have my money. You're telling me I can't actually talk to a live person there about it. So, anyways, I'm sure we're probably getting a lot of people who are similarly outraged with aspects of their life. And folks, if you do, share those in the comments. But anyways, Lance, I do think that may be a vector at which future entrepreneurs will be able to get competitive differentiation going forward. If you really laser in on service here, I think so much of at least the American consumer audience is so tired of being treated like a second or third class citizen that even just a little bit of going above and beyond customer service wise may actually earn you some serious
Oh, yeah.
loyalty.
No, that's why we spend so much time in our shop focusing on customer service. I mean, it is the number one priority in our shop, which is customer service, customer outreach, customer contact, all those type of things. Because again, especially when it comes to money, people want to know when something like this is happening that there's somebody paying attention to their money.
Yeah, yeah. And it's just amazing to me how many companies that do deal with your money make it impossible to talk to a live person.
Mhm.
It just boggles
Yeah.
the mind. All right. Well, look, if the thing that gives you the biggest warm fuzzies as a consumer of service is watching Lance Roberts on this program week in and week out. Please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help in figuring out how to position your portfolio for a lot of the macro issues, challenges, and opportunities that Lance and I have talked about here, feel free to get them from one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Lance himself and the team there at RIA, who are totally excellent at client service. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form, and the firms will be in touch with you forthwith after you do that. Lastly, I just want to remind folks that the Thoughtful Money Spring Online Conference is just a week away at this point. As I said at the beginning of this video, if you haven't bought your ticket yet, buy it right now while you can still get the last chance to save price discount, because at midnight, tomorrow night, Sunday night, price then jumps up to full price. To do that, just go to thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, look in your email for the code I've sent you that you can use to get an additional $50 off of that price. As a reminder, again, it's the conference is just a week away. It's going to be Saturday, March 21st. Don't worry if you can't watch live that day or can't watch the whole day, because replay videos of the entire event, all the presentations, all the live Q&A will be sent to everybody who buys a ticket within just a couple hours of the event's conclusion. Real quick, I'll go through the roster just to prove that it's one of the best you've probably ever heard for a conference like this. It's Lacey Hunt, who will do his usual graduate level kickoff, Ed Dowd, Michael Oliver, Matt Taibbi, the journalist, Luke Roman, Brent Johnson, Stephanie Pomboy, Grant Williams, Michael Oliver, Darius Dale, Judy Shelton, Danielle DiMartino Booth, Rick Rule, Lynn Alden, David Hay, Melody Wright, Andy Scheckman, and then the financial advisory firms that you see with me on this channel as well. So just a murderer's row of talent there. It's going to be an amazing day. It's going to be 11 hours of content. We try to really over-deliver value for the low price of the conference, and I really hope to see you all there. Lance, my friend, another great week. A lot of stuff going on in the world. Kind of shudder a little bit to see what surprises might lie in store between this week and next week, but whatever they are, we'll talk about it here together. Thanks so much for making sense of everything for everybody.
See you next week.
All right, everybody else, thanks so much for watching.
Silver is going to fail to deliver. In my eyes, that's within the next few delivery periods. So I think before year end, you're going to see the silver market break. That will immediately spill over to gold. Clearly, China has way, way more gold than they say they have. I think probably Russia too. And just go back to the old saying, he who has the gold makes the rules. And that's what they're preparing for. They're preparing for the dollar/bonds, treasury bonds to implode.
I mean, so much is going on under the radar here. And that's probably because a lot of, when you think about the gold that's flowing into China, gold and silver flowing into China, it goes through 42 customs districts, which have 680 individual customs offices. I mean, there's so much fiddle room here. It's unbelievable.
Given that failure to deliver is expected to occur during the next few delivery cycles, probably before year-end, the silver market appears to be on the verge of collapsing. The shock would swiftly leak into gold if that were to occur. As the USD and US Treasury bonds teeter on the verge of collapse, China and Russia are likely holding significantly more gold behind the scenes than they acknowledge. While central banks currently hold almost 36,000 tons of gold, making it the second largest reserve asset after the dollar, and, in some ways, surpassing the euro, China is relaxing gold trade regulations to facilitate physical movements. Gold has reached fresh highs due to geopolitical threats, record central bank purchases, and waning dollar outlooks, and a WGC survey indicates that the majority of central banks want to boost gold holdings while cutting dollar exposure. Bill Holter, a well-known precious metals analyst and commentator, with Andrew Maguire, a veteran precious metals trader, highlights that gold and silver are seen as the ultimate hedge because, unlike paper assets, they can't go bankrupt. Recent reports show gold and silver prices are rising due to heightened geopolitical tensions, weak dollar expectations, and inflation concerns. Silver has lagged gold somewhat, but many commentators believe the gap, gold-silver ratio, indicates silver is undervalued. Silver, in particular, looks to be breaking out as China tightens its grip on the physical market, leveraging that position to influence paper trading. For years, nations like Russia and China quietly accumulated metals to avoid direct confrontation, wary of U.S. military power that historically enforced dollar dominance, examples being Saddam Hussein and Gaddafi, both eliminated after pushing for gold-backed alternatives. Dalio warned the U.S. economy is showing signs of a financial heart attack, driven by rising debt costs, citing its history of rising in crises and protecting against currency devaluation. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Gold and silver, and the reason being gold nor silver can bankrupt. They are money themselves. They cannot bankrupt in a world that is bankrupting.
Absolutely. And I think if we can revert back to silver for a minute, because what we're seeing here is a huge, long-awaited breakout. Obviously, we all know that China has been in the driver's seat for a long time, and they've been playing the arbitrage trade and, being in control of the physical side of the market. They could arbitrage the paper side. But essentially, what we're hearing is, hey, gloves are off now. And especially after Trump's most recent BRICS attack on the BRICS, like clearly putting the BRICS in the crosshairs with tariffs. And then most recently, some very odd statements that he made after the SCO meeting.
Your comment, the gloves are off. I think that's up until this point. I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, "Here's $10 billion, I want metal," it'd be over. There's no way to deliver that kind of metal short term. So it would break the markets. In the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency. And what happened? They were killed. In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein. They saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. So they're at the point now, like you said, the gloves are off, and money is just flowing into, whether it be the physical metal itself or even the leveraged contracts in the West. You're seeing foreign nations buy those.
And I think most recently, and I know we're recording this on the 3rd of September, so it's not really a time-sensitive thing we're talking about here, but essentially what just happened, and I don't think this is clearly not going to change, is that it's quite clear from Trump's comments that the SCO meeting between these major hubs that you're talking about, and military powers as well, really ruffled the White House's feathers here, and they're not handling it very well, because basically, I guess really, I mean, maybe I'm naive to think, wouldn't it be better to have a multipolar world where you take all the barriers down? But I guess US dollar hegemony is the problem here, is it?
Well, that's the problem that the rest of the world sees. The rest of the world wants to get out from under Uncle Sam's boot, if you will, by using dollars. They don't want to use dollars, and they'd prefer not to be in the SWIFT system. I mean, ask Vladimir Putin. The U.S., the West, stole 300 billion plus of U.S. treasuries going back to, 2023, October 2023.
According to Bill Holter, cryptocurrency was created as a diversion from gold and silver, which are the real alternatives to the dollar. Since silver was designated a key mineral in the United States, its significance has increased, potentially limiting world supplies and retaining domestic production. Deficits are growing as Mexico's output declines and industrial demand for electronics, EVs, and solar rises. Silver may also be withheld by nations until prices significantly increase. By 2026, analysts predict prices to reach between $40 and $52.50 per oz. However, since no fiat could purchase gold and silver in the event of a currency collapse, they might become invaluable. Let's shift our attention towards the interview.
But I believe that the crypto market was created as a pressure relief valve from gold and silver, because they are viewed as an alternative, a dollar/currency alternative.
But silver's got my attention at the moment, and because you and I always have talked about silver. You've been so far ahead of the curve on silver, and I think it's now being by the US now suddenly naming it as a critical mineral. To me, that would mean that they're caught in a rock and a hard place here, because that means that US mined silver, that they probably start banning the sale of it. It has to be bought internally, perhaps. I don't know. What's your thoughts? Because to me, why would you allow a critical mineral to be sold?
Right. Well, I mean, look at it this way. Naming it as a strategic mineral or strategic metal automatically creates the demand of whatever the government's going to buy. And it automatically reduces the supply available to the market, because that supply is being bought up by the government. So you've already got a disastrous supply-demand equation. They just poured gasoline on that fire.
Yeah, and of course, what you essentially were saying here is that every other central bank, every other sovereign, everyone else is going to say, well, I'm not selling my silver at this price. I want a much higher price, and I don't quite know what that is yet.
The much higher price, I made the comment before we started recording, be careful what you wish for.
Yes, yes.
When we go through $50, and that's if markets stay open. I mean, there could be a failure to deliver, this month. I mean, who knows? But once we get through $50, you've got people talking $100, $200, $600 silver. There's really, in today's world, there is no way to project a number that gold or silver can go to. And I mean, the reason being, the parameters are zero and infinity. And the reason infinity is a parameter is because if a currency goes to zero, then it is priced at infinity in that currency. In other words, no amount of currency can buy an ounce of gold. That currency won't be accepted. And that's where we're headed on a global basis. I mean, if you think that the US dollar can collapse, crack up, and the system remain running, that's not going to happen. It can't happen.
Could the long-awaited decoupling of paper and physical prices be triggered by a real failure to supply silver on COMEX? How long before gold officially threatens the dollar's position as the primary reserve asset if central banks continue to reduce their exposure to the dollar? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Like, I personally have a price target on gold up near 15,000. Not tomorrow, not this year, but in the the fullness of time over the course of this bull market. $15,000 price projection is simply an average of the previous two bull markets, the one in 1970 through 1980, and then you call it 1999, 2000 through 2011. If you average the returns in gold through those two bull markets, that gives you about a $15,000 target. We're susceptible to a sharp pullback, that is true, but we're also, I think the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap. Higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50.
The long-term outlook for precious metals suggests significant upside, with gold potentially reaching $15,000 over the course of this bull market based on the average gains of the previous two major cycles. While short-term pullbacks remain possible, the broader trend points higher, with silver showing strong technical support that could drive it toward the $44 to $50 range, and possibly even $75 if momentum continues. Steve Penny, a respected precious metals analyst, trader, and newsletter writer, explains that after gold first touched $3,500 in April, the forecast was for prices to move sideways with a slight upward bias for several months, allowing silver and mining stocks to catch up. That's largely what played out, with gold consolidating for about 6 months before breaking higher, while silver and miners began showing strong momentum. The key lesson here is strategy. Knowing when to buy is straightforward, but investors must also plan their exits. Bull markets are volatile, with sharp swings both ways, so deciding whether to hold through volatility, take profits, or actively trade is critical. Looking ahead, Steve Penny mentions that the dollar sits at an important support level after months of decline, which has boosted precious metals. However, an unexpected bounce in the dollar could trigger a sharp pullback in gold and silver, especially since gold is at its most overbought level on long-term charts since 1980. While the long-term outlook remains extremely bullish, with targets of $15,000 gold and $200 plus silver, caution is advised in the short term. The strategy suggested is to trim speculative mining stock positions as silver approaches $50, then keep cash ready to buy back on pullbacks. To ensure you never miss an update, don't forget to subscribe and hit the bell icon as we begin the video. We appreciate your feedback, so please leave a comment below and give us a thumbs up if you found the article interesting.
After the April peak, where we first tapped $3,500 in gold, my forecast, I believe we talked about this. I know it's been a little bit since we spoke, but I was saying, hey, I think it's very likely that we just kind of grind sideways in gold for a few months to maybe a quarter or two. And, that's not what people want to hear when it's just ripping straight up and stocks are going down. We want to hear to the move. Well, that was back in April. Well, April, May, June, July, August, now we're into September. So 6 months almost of just kind of sideways, and now we're finally breaking out. But my forecast was that gold would just kind of trend sideways to maybe with an upward bias, and that would allow silver and the mining stocks to play rapid catch-up, and we're beginning to see that. That's finally coming to fruition. Now, as I share a couple of charts here, I just want a key takeaway from this interview is for people to think about your strategy. Knowing when to buy is fairly easy. It's when everyone hates it. But, everyone needs to have a personalized exit strategy of, are you going to just sit through the wild volatility? Are you going to take profits? Are you going to trade around your mining stocks? These are important things to think about, especially as things begin to move, because these bull markets are incredibly volatile. And you were seeing the volatility to the upside now. And as surely as night follows day, there will be volatility to the downside as well. So the question is, do you want to sit through that? And here's kind of a basic roadmap I have. Now, I think any roadmap should be taken with a grain of salt because no one knows the future, right? But charts, one thing charts help us to do is, make if-then statements and have a roadmap. And then we adapt as new information comes in. And when I look here at this long-term chart for the US dollar, what I see since 2008 is a gently rising uptrend. And where are we at right now? We're right at the lower rail of that uptrend channel. And of course, the dollar has been declining for several months now, for a while. And that's been a tailwind to hard assets, namely precious metals, silver and gold. Well, I think what a lot of people maybe aren't expecting is for a pop in the dollar, an unexpected pop in the dollar. And that could result in a sharp pullback in the precious metals. I mean, we've come really far, really fast. Gold on the monthly chart is now the most overbought it's been on the RSI since 1980. It's the second highest overbought condition ever. That doesn't mean it can't go higher. And I'm not saying that. You're talking to someone who's probably as bullish as you can possibly be. I just told you I think gold's going to 15,000. I think that's fairly conservative. Silver, $200-$300 or more. But at the same time, over the short term here, I think caution is warranted. So I'm certainly wouldn't be chasing, gold and silver here. But you can see on this dollar chart, we followed the roadmap so far. I drew this potential path a while ago, and we've declined. Well, now here we're sitting right at the lower rail of the support. I could see some kind of exogenous shock causing a pop in the dollar. That just intuitive reactionary flight to safety, perceived safety, because you and I both know, the dollar should not, be a safe haven, but that's the knee-jerk reaction when panics happen. So I think that could happen. That could see a pullback in precious metals. And, how you want to trade around that is obviously for you to decide. But for me personally, I plan to take a little bit off the table in my speculative mining stock positions as we move up towards 50, if that does indeed happen in silver, and then have cash available to scale back in on any kind of pullback.
Steve Penny, in an interview with Liberty and Finance, points out that in silver bull markets, most of the gains often come in a short burst near the end of the cycle. While silver could face pullbacks, the technical setup suggests prices are headed toward the $1.44. That may be a good point for traders to take some profits in paper positions like mining stocks, while physical silver remains a long-term insurance policy. For gold, prices are already in a zone where trimming speculative exposure could make sense, as miners like GDX show extreme overbought signals despite gold being far higher than in past cycles. At the macro level, Steve Penny thinks that the Fed is under immense pressure as soaring debt makes interest payments unsustainable. Historically, governments always choose to debase their currency rather than default, and the U.S. is no exception. With markets expecting a rate cut soon, the real test will be the long end of the yield curve. If long-term rates rise even as the Fed cuts, it would show a loss of control, likely forcing extreme measures such as yield curve control. That scenario would accelerate the bull market in precious metals, fueling even stronger gains ahead. Let's get the interview started now.
90% of the move in silver bull markets happens in the last 10% of the time. And, that may not be exactly numerically correct, but conceptually, I believe it is, where you get the biggest moves in the last part, of a bull market. I'm not saying the bull market is over, but my point is, right now, we're susceptible to a sharp pullback. That is true, but we're also, I think, the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap for hitting higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50. So the short answer is I think we're probably headed somewhere between 44 and 50, maybe a little bit higher. But I think that could present an opportunity to take just a little bit off the table in speculative positions. Now, I just want to give a caveat. When I say that, I'm talking about paper positions. I'm not talking about going to sell your physical. To me, I view physical as a generational insurance policy against these out-of-control central planners. I don't trade that. I'm talking about if you're into mining stocks, if you're into paper trading vehicles, that could be a time to take a little bit off the table between 44 and 50 in silver. That's kind of what I'm looking to do myself.
And as for gold here, do you have any price targets of where maybe taking at least some paper profits off the table would be a good option?
Yeah, so I think in gold, we're probably already in that territory. So one of the cool things probably isn't the best way to put it, but one thing about when you're in new all-time high territory, a lot of people think that's bearish. Oh, you're overbought and it's all-time highs. Well, that's actually can be bullish, as there's now no overhead resistance. But you can use kind of like price projections and measured move targets. And my measured move target for this year was about 3,500. So we've already exceeded that. So I think this could be right around in here between 3,500 and 4,000. You know, if you're in big gold miners, like you can look at a chart of GDX, and that would probably be a good one to pull up. But like on the chart for GDX, we're getting extreme overbought, and we're closing in within, you know, spitting distance of the all-time high resistance at GDX. Now you can make a case, last time GDX was at this level, gold was $1,900 back in 2011. And here we are, $3,600 gold, and GDX is just getting back to that same level. So you can make a case that it slices right through it like a hot knife through butter. However, you know, just from a purely technical perspective, we're getting overbought here, right now, in the big gold miners. And before I moved on, I did want to just share this chart for GDX. This is that long-term monthly chart. And you can see, look at this RSI right here on the top right of the screen. I'm hovering over it for anyone watching on YouTube. The monthly RSI is at 80. That's the highest ever on record. Not like an immediate sell signal, but it's a caution signal. Kind of be aware of that. And as a general rule, when you get extreme overbought against clear, obvious resistance, typically you don't punch straight through it. So big gold miners, you know, that just reinforces the case to maybe take a little bit off the table before, you know, I think we're ultimately going much higher. So it's up to, you know, individuals if they want to just sit through that volatility or, you know, kind of use volatility to your advantage. I look at like the drama going on between the Fed and the president as kind of theatrics and a sideshow. It just highlights what you and I have known for a very long time, and that's Tina. There is no alternative. The Fed is between a rock and a hard place where they have to choose between sacrificing the dollar or sacrificing the economy. And history is replete with examples where central planners, those in power, always choose to debase the currency as opposed to default honestly. The federal government's in a situation, by the way, this is all governments around the world, every single one, 100% of them, are in a situation where the debt is mathematically unrepayable. So they can choose to either debase the currency or, you know, default, honestly, and they never choose to default. So they're going to debase the currency, and that is just explanation for why there's such pressure on the Fed to lower interest rates and, you know, make more easy money to try and kick the can down the road. Because the biggest variable, we're heading to a point, and this is something I think everyone should understand, we're heading to a point where 100% of our tax dollars, 100% go to just service interest on the debt. That's the trajectory we're on. And the biggest variable in that equation of how to kick the can down the road is lowering interest rates. So, you know, no one wants this, you know, currency crisis to happen on their watch. So how do you kick the can? Lower interest rates. And that explains why there's such pressure on the Fed. And I will throw something out there. The futures markets are pricing in like a 90% probability that the Fed will cut rates on September 17th, just a couple weeks from now. The thing to watch is, and I'm not predicting this, but it's something to watch, is the long end of the curve. Watch the 10-year and the 30-year and see if, as the Fed cuts rates, if rates actually go up. That would be an early warning sign that perhaps the Fed is losing control. If they're cutting rates and then the long end of the curve, you know, interest rates rise, that would indicate they're losing control, and that would indicate that they're going to need to apply even more dramatic measures like yield curve control, which when that happens is just going to be like pouring gasoline on the bull market in precious metals.
Gold and silver remain in powerful long-term bull markets, with potential for historic gains driven by currency debasement, debt pressures, and shifting global demand. While short-term volatility and pullbacks are inevitable, the broader outlook strongly favors higher prices, making precious metals both a strategic investment and a form of financial insurance. Do you think the Fed will be forced into yield curve control sooner rather than later? At what price level would you personally consider taking profits on silver or gold? We'd love to hear your opinions, so please leave them in the space provided below. If this video was useful to you, please give it a thumbs up and remember to subscribe for more. Thank you for being a part of our journey.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening. So Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast. When Donald Trump gave his first speech as president and announced the golden age in America, I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year. Right? Gold is killing it. In fact, Bitcoin is 13% below its peak. Right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. Maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price. But he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But no, gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.